Hello, everyone. Thank you for joining us. Today we have a very special guest, Dotun Rominiyi. Hi, Dotun. He leads the blockchain and innovative strategy at the London Stock Exchange Group. Hi, Dotun. Thank you for joining us today. My name is Jin. I'm a CEO at Stobox, and also we have Boris, who is the head of analytics team at Stobox Group as well.
Thank you, Jin.
Yeah. Again, thank you. And in terms of our speech, I think we can divide it into like three groups of questions. So the first is a blockchain for enterprise, and the second would be like the regulatory environment in UK, and the last one would be what would be the future, how you would see the future of the blockchain development from a London Stock Exchange perspective. So let's start. I mean, we see a lot of STOs and different movements on that. But in terms of the relationship and attitude of bigger guys and financial institution, what is the attitude towards the digital securities or security tokens from institutional point of view?
So I think it's a fairly broad question, and it really depends on kind of which part of the ecosystem really you're thinking about, right? So, what we see from our perspective as a kind of financial markets infrastructure provider, there's clearly a lot of inertia building. There's a lot of focus and a lot of investment going into the exploration and the development of solutions, specifically around trying to solve for, let's say, the big gaps right now around digital securities, and really that's enabling the kind of end-to-end automation or digitization of the life cycle of these assets, and ensuring that you can have kind of like a clean and seamless transition as those assets move from, let's say, primary markets issuance through kind of OTC trading to listing and admissions, trading, and then kind of secondary market trading, clearing and settlement, right? So there's a lot of work going on. On the Swiss side, we see SIX, done a lot of investment and are continuing kind of with their initiatives. Deutsche Börse have some fairly large-scale initiatives as well, working closely with Euronext to develop some infrastructure for that. The Australians have been working on projects on a project for quite a while now, and they're kind of probably closest to delivering something into a live production environment. And then similarly, we have our own initiatives as well, in the FCA Innovation Sandbox, looking at kind of, sort of exploring, a solution for post-trade settlement specifically for digital assets. But I think, looking more broadly, it's really around solving for that gap. So, you have these assets that, are ultimately securities, right? Regardless of, in what form they may take. They clearly need to adhere and comply with the existing regulatory regimes that exist both in the UK and across Europe. And so in order to facilitate that, we need essentially a technology or an infrastructure model that maps well to the existing, let's say, market structures that we have today. And what that essentially means is, in the context of primary markets, it's fairly easy. You can have systematic solutions for originating these assets, issuing them, and then allowing them to kind of move around the ecosystem fairly seamlessly and be settled directly via DLT. But in the context of listed trading of these assets, there's still a gap around having MTFs that can list them, and venues that have the capability to clear and settle these assets essentially. So we're seeing the evolution of that maturity, right, in the ecosystem, solutions being kind of built up and developed, but it will take some time for that to be fully realized. I think, and as you move maybe further out and you look at some of the other institutions, investment banks, etc., I think for a lot of them, they're looking at, what is the value proposition that this technology brings to the table, and where's the client demand? So looking at, what benefits does the technology provide in terms of, let's say, automation of voting rights, automation of distribution of dividends, and coupon payments, let's say, for debt instruments, and similar. And how do we realize that for clients? How do clients see that, and they will invest based on the kind of client appetite as it continues to grow and develop.
Yeah, thank you very much for an insightful answer. maybe it's a simple question, but some of our listeners may be not aware of, the technology framework. Is it right to say that everything that you mentioned would be based on a blockchain-driven framework that would allow that to happen? So is it the blockchain that makes that happen? There's other technologies that can be on the market and making that happen as well.
Yeah, I think it's a good question. I mean, so where you look at some of the inefficiencies of capital markets today, where you look at specifically primary markets issuance, there are lots of kind of manual processes and lots of, let's say, cross coordination between separate legal entities that needs to happen as part of that workflow. Can blockchain provide part of a solution to that? Yes, but I think there's another part which is just pure, automation, right? So providing technology solutions to streamline some of those workflows, where you have specific, let's say, regulated institutions that have certain authorizations to conduct certain activities, so you can't fully automate those activities and such, disintermediate those institutions. But what you can do is you can streamline those processes, right, and then essentially bring down both cost and time to market, which is kind of the two important pieces, right?
Definitely.
And so yes, blockchain can provide part of a solution, but it's not the only part of the solution. It's more just your general kind of digital transformation. Let's put it that way. But when you get beyond that, when you look at kind of the broader ecosystem and enabling DLT trading and clearing and settlement, and allowing these assets to move across the ecosystem, one of the interesting aspects of distributed ledger technology is its ability to allow you to convene multiple independent commercial entities and separate organizations, and allow you to essentially streamline and let's say automate those workflows between them in a way that would be very difficult to do from a kind of commercial and competitive perspective with a wholly centralized solution. Essentially, the only other way to do it would be a full vertical integration of the market. So it's an organization buys up all of the participants and then essentially provides all of those functions. So yeah, I think one of the interesting aspects of the technology is it does really provide a means to do that. And the way that the challenge is really coming in terms of how you build and deploy those solutions, and then essentially how do you convene those participants to essentially adopt that technology.
By implementing a complex system of roles and permissions for who can access or who cannot access certain layers of information.
Part of it, yes, but I'm thinking more along the lines of commercial balancing, competing in commercial interests, right? So, and risk appetites, and infosec considerations. There's a lot of dimensions, and corporate governance, and kind of political control of corporate governance, across a group of separate parties in the ecosystem. There's a couple of dimensions, right, that you need to consider.
Definitely.
But yeah.
Thank you.
Thank you for insightful replies, Dotun. We've seen many of enterprises using proprietary private blockchains built with Corda, with Hyperledger. And on the other hand, public blockchains came through much of the evolution, shifting from networks simply for crypto kitties and gamblings to network used sometimes by government to store some medical records, etc. So do you see anywhere in the near future interest in institutions using public blockchains for storing records about the securities for clearing settlement or other purposes?
So, and I think it's an interesting question. I think that there are several challenges with public blockchains, and from the conversations that we've had, from the explorations and analysis that we've done, it's very hard to justify the use of public blockchain specifically for some of these highly regulated and in many instances systemically important activities, right? So there are implications around security and risk. How do you ensure that you have almost perfect security around control of public and private keys? How do you ensure that you have full control over the authority of specific regulated actors performing those activities, right, and not losing control of that authority as a function of the let's say a smart contract exploit that some external entity is somehow able to circumvent the technology and then get into. Privacy is also a big consideration, and I say privacy, but also balance that with transparency, in the sense that in a regulated market, every institution must have full certainty of who they're facing off to whenever they're conducting any form of regulated activity. So it's very difficult in the context of a public blockchain network, where there is open access, at least at the technology layer, to be able to really provide that kind of certainty. And I think these are some of the considerations that make it very hard for institutions to look at public networks, public blockchains as a kind of a viable foundational layer for some of these activities. Now, that said, that's not to say that there isn't value in public networks. What public networks are very good at is enabling very fast and very agile innovation and technology-led innovation to solve for some of the business and workflow challenges across capital markets and across other industries as well. And I think what you will start to see is essentially a landscape that provides robust and secure and heavily controlled permission networks for your core infrastructure, for your systemically important activities, such as, let's say, clearing and settlements. But as you move away from that kind of epicenter, you'll have kind of key integrations with some of your public network technologies that enable your kind of more agile, let's say, primary market issuance solutions to plug into that infrastructure, right? To be able to support the activities that they need to layer products and services on top of that infrastructure to get access to the data that exists within the private networks. But essentially all of that is, let's say, intermediated through known and controlled and regulated actors, essentially.
And that would probably open higher access to participation in the financial industry, the usage of public blockchains.
Yes, absolutely. And again, it goes to the ubiquity of access to the technology, and the ability for there's a much lower cost of entry in terms of being able to provide and build and deploy solutions onto those networks. And it allows you to, let's say, build and develop ecosystems very, very organically, but also quickly, right? And so I think just in terms of its ability to foster broader innovation, there's a lot of value there. The ability to provide solutions, products and services that deliver value very quickly, there's a lot of value there. But again, in the financial service space, what regulators care about, what regulated companies care about is risk, and how do we manage and control for risk. And in the context of public ledger technologies, it is an evolving problem, as in the solutions are essentially evolving, right? So they will mature over time, and you will see much more robust solution to solve for privacy and certainty around control and transaction finality, for example, on probabilistic consensus chains. But that will take time.
Definitely.
Probably technology has appeared not so long ago, and we have many years to go. And I wonder, in terms of the evolution of the business models. So blockchain mainly is used for the reduction of cost and optimization of processes, but also it may open new business model. The best example is a decentralized governance of organization in principle. So do you see people in big enterprises expressing interest in such models, and do you think it can ever happen given the high regulation in the space?
So again, it's a very good question. I mean, I think as a general statement, does blockchain and DLT technology enable business model innovation? Absolutely. And I think when you look at it through the lens of capital markets and the financial service industry, we see as that being kind of part of the key proposition, right? That is really pushing, let's say, the winds of change. In the initial instance, there may be some efficiencies gained by laying that foundational infrastructure with DLT. There may not be. I think that's still an open question that a lot of the larger players that are pushing for building and developing solutions in that space are really still trying to bottom out. But I think really what it is about enabling these kind of broader business models, looking at opportunities for service unbundling, democratizing the provision of service within the financial service sector, and it's mainly around reducing cost on the front end that enables that. And then separately, providing this ubiquitous infrastructure such that it becomes very, very easy for companies to layer products and services on top of this technology that have direct systematic access to those assets at whatever point of the asset life cycle they exist, to be able to automate workflows and fund distributions around funds into these assets and out of these assets, for example, as we mentioned previously, and some of the other activities and workflows and processes. And again, I think once you have that infrastructure in place, it gives you a lot more possibilities in terms of even how you define these assets fundamentally. So there is scope for new types of financial instruments that don't exist today, purely as a function of the existence of this infrastructure once it's there, once it's robust and mature, proven, and accessible.
Thank you. Thank you for that. We've seen, and I'm sure that most of the people who touch the subject of digital securities, they look at the implication of the security token offering. So it's a primary offering. And also we see that there is a number of progressive jurisdictions like Liechtenstein. They have already a DLT law for that. Switzerland is a very pioneering in this space. Even US with their old legislation system, but it actually kind of fit into the digital securities framework. But we don't see much of the development from UK. So there's zero, as far as I know, there's a zero as security token offerings from UK. Why do you think is that?
I mean, I can't talk to the number of STOs that have essentially been launched from the UK to date. I mean, but what I can say is, I mean, in terms of kind of the regulatory frameworks that exist around security token offerings, I mean, I think in many respects, both the UK and EU-wide, that the regimes that exist today are wholly suitable, at least from a primary markets perspective, to provide the necessary frameworks to allow issuers to be able to issue digital securities safely and investors to be able to make informed decisions about investing in these assets. It may not be entirely set up to facilitate, let's say, more retail access or broadening the scope of retail access to these instruments, but that to me is not a technology problem. That's an economic problem. That's a risk problem. That's a financial stability problem. And therefore, whilst there may be technology solutions to solve for that, more work needs to be done to understand exactly how you can do that in a way that, as I said, does preserve financial stability and mitigates risk on the behalf of the investors themselves.
We haven't dived into the specifics of FCA regulations and the UK regulations in terms of digital securities. But again, we can see there's still some work to be done in that respect from the regulatory part.
No, I was going to say absolutely. I mean, I don't believe there is a need for much in the way of change with respect to the regulations. But I think we are seeing at least the seeds of innovation in line with and compliant with current regulatory regimes in the UK and across Europe. But we look at the work that Navora have been doing, the work that, let's say, GlobalCap have been doing. Archax are building a secondary a trading venue specifically for security tokens as well, and even ourselves. We have a number of initiatives that we've been working on in this space. So again, I think there is room for innovation in building and developing. There is exploration as well around when you look at let's say the cash side of things, CBDC and the potential benefits that it may provide both in the wholesale and institutional space, but also on the retail side. So yeah, I mean, I think there's scope for development and growth, and I think innovation will continue. But I think I think there is a view that we have very robust legal and regulatory frameworks in the UK and across most of Europe, and we tend to be, let's say, a little bit more conservative than, let's say, aggressive in terms of, let's say, the speed of let's say, innovation. So maybe that's a factor.
Like we've met, we've originally met in Malta, and this is the case with the country that actually did quite the opposite. So they opened the door for all the companies to enter, and we were one of the 760 whatever companies that were applying for the license, to get a license to deal with digital securities. But at some point, they just withdrawn from any licensing, and as for now, the whole blockchain island being suspended as a concept. So we had to move from there, but I understand why UK chooses a different approach in this
To become
respect.
in a blockchain island.
Not to become in a blockchain island like Malta did.
Yeah, I think, again, just to kind of bring it back to that point, like, when one understands the fact that ultimately regulation is intended to be technology neutral, and it's really around regulating activities, right, and the conduct of those activities fundamentally, then I think it does raise questions, right, around the haste in which Malta scrambled together let's say a parallel regulatory framework specifically around DLT based or tokenized assets and securities being kind of a part of that. So, and I understand why they did it, but sometimes you just need to spend a little bit longer to understand where's the real variation in the activities that are being conducted here, and what do we need to do to be able to build a framework to solve for that, or what do we currently have that already solves for that we just need to essentially reinforce and provide that kind of comfort to the market that, look, this is the clarity that you need to be able to move forward.
Definitely, we'll understand like where it should go, and it's just a matter of different paths.
Sure.
Yeah.
Let's proceed to speaking about the interesting projects and where the industry is heading. So, as far as I know, you've been working on the blockchain with I don't know exactly what the blockchain was built in regulations for settlement in the UK. So I wonder, what were the main challenges you faced, and do you believe that at some point all regulation will be basically automatically enforced, at least regulations, the securities will be automatically enforced by the technology, and you won't have the risk of being non-compliant or committing a fraud?
So very good questions. I mean, we've done a lot of extensive analysis around, as I said, the UK and EU regimes, right, that govern, let's say, security settlement in the specifically around financial instruments, and how that relates to DLT and a potential DLT solution to solve for that. When we look at, let's say, CSDR, for example, and the Security Settlement Depository Regulation, or the USR's uncertificated shares regulations, when we look at the Settlement Finality Directive across Europe, or when we look at the Prospectus Directive across Europe, what we see are specific requirements that don't necessarily create challenge, but let's say add complexity to a view of how do you design a solution that's leveraging DLT that can solve all this. To answer the question of, will we ever reach a stage where we can obviate the need for, the need for intermediation, essentially is what you're asking, right? Can we so automate some of these activities such that we won't need specific entities that would have to stand in the gap and therefore provide these services? I think it's a difficult one, because there's such regulation is such an interesting area, and where we look at, let's say, rules around who can access and invest in certain types of securities, and yes, there may be elements of that are relatively trivial to systemize and automate, but there are other types of regulations and other types of requirements that are maybe not so much. So when we look at, for example, some of the rules around listing and admissions for securities onto an MTF, there are requirements around corporate governance and financial reporting that are basically impossible to systemize. I mean, you can't automate having a board in your organization, right? So these are the types of requirements that will always remain, and therefore you always need the structures and the processes that can enable businesses to become compliant. And whilst you may be able to streamline and reduce the cost of compliance for some of these functions over time, there are inevitably others that you just there is always a limit to us, that will determine kind of how far you can go. And then the other side of regulation as well is when we look at directly the CSDR regime specifically, whilst we understand that the technology enables the kind of, let's say, atomic bilateral settlement of assets, such that, assuming you had a pre-funded model, you could conceive of a world where, you know, settlement is real time and you don't need a CSD. The challenge with that is that's not the world that we live in today. Settlement generally operates in a credit-based model, and it's very useful for building liquidity and amplifying the available liquidity in the market. So on that basis, having a deferred settlement model is useful, but the second you have a deferred settlement model, you can't automate the guarantee of settlement, because if I have stock today and I trade today and settlement is, let's say, T+1, I still have the ability to trade out of, you know, trade away my stock, and therefore that I may not be able to meet those obligations and at the end of my settlement window. And whilst you can add controls around that, you can't, if you're going to accept a deferred model, a credit-based model, you can't solve for that exclusively by technology. And therefore, it's really around how do we manage risk, and you can bring in solutions to manage risk, but really it's around having some entity, person, organization to somehow underwrite that. Whether that's going to be a CCP, whether that's going to be a CSD, whether that's going to be the central bank, whether that's going to be a private entity or private institution, you still need you still need the mechanisms, the let's say market structures to facilitate managing that risk. And much of, you know, the service provision in financial markets today is actually around risk management. There's a lot that is you know, fundamentally predicated on that as a value proposition. So.
Thanks for your reply. So it seems that there are only certain things that you can automate. Actually, it is 80-20. So even if you automate 20% of things, if those are most time consuming, you still win a lot if you can do it.
Yes.
Actually, we are also working on that matter, although we are not in the working not in the field of public markets, but in the field of private offerings. Also,
sure,
SCOs are semi-private, semi-public offerings. But still, you can simplify, you can introduce quite, not very complicated actually regulations to comply with prospectus directive or regulation D, just, for example, not to sell securities to wrong investors and not to sell too much of them. And you still a lot reduce complexity for the issuers to manage everything and reduce risk of error. So probably you don't, even though you don't need to automate everything, some automation is hugely beneficial.
Absolutely. No, absolutely. Yeah, I agree with that.
And I wanted to ask you in terms of the, speaking about private markets, if you're working with that as well, for digital securities in private markets, one of the key liquidity is considered one of the key roadblocks. So until there are working regulated markets and or other trading venues, it is said that the investor interest in the market won't be enough. So how do you think, what do we need in order for the liquidity to emerge, and whether we will see the promises of disruption of private market that everybody is speaking about for, I don't know, 3 years or how much, even more probably?
Sure. So there are a couple of dimensions to that, to answering that question, that I think is kind of that makes it interesting, right? So, you know, solving for private markets is tricky from a liquidity perspective, because you only have two options, right? You have the option of providing infrastructure to better facilitate OTC trade flow, right? And even then, you know, there are clear restrictions that you have to adhere to. So, for example, you can't just build a convening solution that matches, you know, multiple independent buyers and sellers, you know, on multiple sides of the book. Because suddenly you're in the realm of, hey, you know, this looks like an NTF, and there's a whole, you know, regime of regulation around, you know, governing what constitutes a multilateral trading facility and how you then essentially, you know, run and operate that. So it's a tricky space, and you know, you do see solutions even today, ignoring blockchain, you know, bulletin board based technology solutions that enable the kind of, you know, brokering of buyers and sellers and management of quotes and negotiation, but where settlement essentially is entirely handled off the platform. And so I think, you know, that there is still room in the world of, you know, asset digitization to provide similar such solutions. But again, you have to tread very carefully as a service provider. and even moving beyond that, you know, just looking at how the assets are issued, I think there's a lot of opportunities to, you know, streamline some of the DD processes across institutions, streamline some of the processes in, you know, negotiation and deal management. So liquidity is always an interesting one, right? And we have lots of conversations around this. But I think what's fundamental to me, or fundamentally apparent to me, is that liquidity itself isn't a technology problem; it's an economic one. And when you look at it through that lens, you have to deal with the problem of liquidity on a case-by-case basis. Assets have a certain scale of demand in the ecosystem, and that demand can be shaped by improving access to those assets, or reducing the friction of asset, or timed friction of access to those assets, whether there be, you know, time or complexity of acquisition. But ultimately, you know, there is inherent value that drives demand of assets, right? So for example, we could tokenize collector's art, but that's not going to say it will suddenly take collector's art from the size of the market that it is today to the size of, let's say, you know, the global equities market, right? A multi-trillion-dollar market. It may very well not happen, because there is intrinsic value in having access to that asset that is specific to that asset. So really what I'm trying to say here is, when we think about how do we enable liquidity for, you know, digital securities, you really have to ask the question of, how do you better enable liquidity in the actual asset class, and what are the problems that are inhibiting, let's say, the realization of true demand for that asset? Because you may find, you know, where you look at certain asset classes, even having the ability to list those assets on an MTF may not necessarily boost liquidity. I mean, we have, you know, equities, so mid-cap equities on our AIM markets that are fairly liquid today. So just having the ability to list an asset doesn't instantly provide liquidity. It provides access to liquidity, but really it's about enabling the underlying demand that exists for that asset fundamentally.
Definitely. Probably one of the things lacking in the market of private securities. So it was a very good observation that you do have, for example, bulletin boards for institutions trading in private assets. What we don't mostly have is retail access to investment in private equity. So this is how you, and actually retail investors have much lower breadth of investment opportunities, and especially high yield investment opportunities. So there is definitely a demand, and this can definitely add to the depth of the market of private securities, and at least somewhat improve its liquidity. And on the other hand, the big benefit I see is when people are given a choice, either invest in very low yield investments such as bank deposits, or in the very risky but very profitable such as ICOs or MLM schemes, etc. Many choose these schemes that often result in scams. So giving something in the middle can somewhat eliminate these that are scams, deprive them of funding. And this will also be very beneficial, especially for those of retail investors who are on the poor side of the spectrum and who give their money to such things.
So, and I think that's a really good point. I would like to key into, though, what I would see as more of an underlying theme to that, though, to that narrative. And it's really around, again, risk. And I think, you know, when we consider, you know, what makes a high yield asset, well, likely it has a higher risk profile. And generally what you see, you know, in financial markets today is risk is something that we take very, very seriously, because it's so fundamental to, as we say, financial stability. And if you allow at scale access to high risk assets, when you consider the realities of information asymmetry, most people are not going to understand the dynamics of these assets. Most people are not really going to understand the specifics of what makes one asset more risky than another. And therefore, if you allow at scale broad retail access to risky high yield assets, the attractiveness of, you know, the purported yield will, as you say, you know, drive a lot of interest and a lot of demand. But you may very soon find yourself in a situation whereby lots of people are losing money, grandmas are losing their life savings, and it creates a real problem for financial stability across the broader economy. And so this is why in financial markets today, a lot of the regulatory regimes are set up in such a way that actually, in many ways, inhibit retail access to some of these financial instruments, because there's again, the information asymmetry. Most retail investors don't have the sophistication in order to be able to understand, how do you price these assets? How do you, how do you measure the risk of some of these things? And so, you need those dynamics. You need to have, either intermediation with an ecosystem that allows, asset managers who are highly trained and understand, how to quantify and measure risk, to be able to invest, investor money, retail investor money on their behalf in some of these instruments, or you need, other measures essentially that can protect the interests of those retail investors, and therefore essentially regulate and provide stability across the broader ecosystem.
I strongly agree. My vision is that one of the models in which opening of the private equity market may work is actually reduction. Oh, what is with my hand? Reduction of the entry threshold into private equity funds. So
Sure.
one of the first actually projects in the STO industry is a venture fund with the entry threshold of $500.
Sure.
Which is very, very low. We also been working with one of the client venture fund that were previously open only to family offices, etc., with minimum investment, as far as I remember, 1 million or even more, and they wanted to reduce it. But then the pandemic came and they somewhat postponed their plans.
Sure. Yeah, and again, I mean, when we look at these kinds of examples, what is the problem that the technology is actually solving? Well, it's really an accessibility problem. You have funds today who could open the doors to retail investment and lower the minimum threshold for investment, right, to enable retail. The challenge is one of most of these businesses aren't set up to manage the relationships and customer support of having, 1 million investors in their fund. Whereas if you had the technology to facilitate streamlining and automating a lot of that management, which you see today in a lot of the larger tech businesses, a lot of online platform-based businesses, these are the innovations that technology have brought to the fore, and these are the types of innovations you're going to start to see. The kind of self-service model of financial services, that will enable broader access to some of these investment options for, as you say, the retail investors, where the risks are managed by the organization and institution, but access is broadened through the use of technology, just generally technology. So yeah.
Probably so. Actually, I remember reading a curious report by PwC that that large institutional investment asset managers may have profit margins up to 60%, and smaller retail investment asset managers may have profit margins as low as 5%. Like 60% and 5%. Of course, partially it's about regulation. So retail funds
Sure.
are more regulated, but also
Sure.
it's the fact that they lack scalable technology infrastructure, and this is a great problem to be solved.
Yeah.
Guys, thank you very much. I think we shouldn't abuse hospitality and keep timing on. So it was a pleasure, Dotun. Thank you for being with us, and
Thank you for having me
thank
again.
you for your insightful answers, Boris. Thank you as well. Bye.
Thank you, Jean. Thank you, Dotun. Bye.